Would the government be willing to risk shaking international investor confidence overnight just to reclaim control of a single gold mine? In Niger, the answer is yes. Recently, the government abruptly nationalized the country's only industrial gold mine previously owned by an Australian company without issuing any warning or engaging in negotiations. The decision was executed immediately, with no conditions and no softening of the blow, raising one big question: why? That evening, the national television broadcast was running late when it suddenly cut to the country's coat of arms and the solemn voice of the announcer. Viewers expecting the weather report and crop prices instead heard a stark declaration: the Nigerian government was taking full control of the nation's sole industrial gold mine. The order, signed earlier that day by President General Abdurrahman Tani, cited serious breaches and the need to protect this highly strategic company. There was no diplomatic language, no invitation to renegotiate, no talk of joint management, and the ownership shifted to the state on the spot, ending all rights of Mckinnell Resources Limited, the Australian operator. What shocked observers was not only the nature of the move but its speed. The nationalization was announced as a done deal and no mention of lengthy legal proceedings, no international arbitration, no warning period. The swiftness suggested a plan long in the making, kept under wraps until the state was ready to strike in a single, decisive blow. Within hours, Niamey buzzed with speculation. International investors scrambled for details. Foreign correspondents crowded the Ministry of Mines, and Mckinnell's headquarters in Australia learned the news from the media like everyone else. The shock was heightened by the fact that gold is a relatively small part of Niger's resource sector compared to uranium and oil, yet the government chose to act so forcefully on this project. The timing was telling. Just 2 months earlier, Niger had nationalized the local branch of French uranium giant Renault, a move that further strained relations with Western capitals. Seizing another major asset so soon afterward was unlikely to be coincidence. It looked like part of a deliberate strategy, one that placed Niger on a collision course with powerful mining nations. The message was unmistakable. This was about national sovereignty. In the official broadcast, SML was described as a highly strategic company essential to ensuring the nation's natural resources belonged to the people of Niger. The wording sent a signal abroad while reassuring citizens at home that the state would not shy away from confronting foreign corporations to protect national assets. On the ground at the mine in Niger's southwest, the scene was outwardly calm. Security forces had increased their presence, but workers remained on the job, and the government pledged to keep operations running under state management. There was no immediate word on whether foreign technical staff would stay or whether the workforce would soon be entirely Nigerian. Still, major questions remained. Why act so abruptly mid-year instead of waiting for the contract to expire or negotiating a buyout? Was there some triggering event that forced their hand? It's possible the decision had been brewing long before the public knew. To understand why the government moved so decisively, you have to see SML as more than the gold it produces. For Niger, it's not just an industrial facility, it's the foundation for a national ambition to move from exporting raw resources to adding value within its borders. Located in a geologically rich stretch of the West African Gold Belt from Ghana in the south to Senegal in the west, the Siet-to-Liptako deposit ranks among the most promising. While Niger's share of the belt is less developed in its numbers, it still has the scale and profitability to compete. SML is even more critical as the only operating industrial gold mine in the country, both a production hub and a model for the nation's gold industry. Its value isn't just measured in kilograms produced, but in its role as a catalyst, building mining infrastructure, extending roads, connecting power lines, and creating processing facility as essentials for future projects. Without this foundation, Other gold-rich areas would remain largely inaccessible to large-scale operations. In reality, SML is the logistical anchor for Niger's broader mining ambitions. The mine's revenue stream is equally vital. In an economy dependent on agriculture and uranium exports, gold offers diversification and buffering against price swings in other commodities. For years, policymakers have seen gold as a potential stabilizer, able to boost hard currency reserves and cushion external shocks. Losing control of the mine or allowing output to stagnate wouldn't just waste an opportunity, it would undercut the country's economic strategy. Its location is strategic as well. Sitting on the banks of the Niger River, the mine has direct access to key transport routes linking the interior to West African trade corridors. Proximity to both river and road networks makes moving goods and equipment cheaper and more efficient, a rare advantage among Niger's mining projects. Beyond economics, SML carries symbolic weight. It was one of Niger's first major industrial mining ventures to attract substantial foreign investment after decades of neglect in the gold sector. Its success could prove Niger is capable of running world-class projects and drawing global capital. But the symbolism cuts both ways. A failure could be seen as proof that Niger's mining environment is too unstable to attract serious investors. Socially, SML is a lifeline of providing direct jobs for hundreds of workers and indirectly supporting thousands more through contracts, services, and local commerce. It's more than a mine, it's a link in Niger's chain of economic, infrastructure, and national image goals. In a country where job creation is a constant political priority, the health of a project like SML is tied to perceptions of government competence. Any threat to its viability isn't just economic, it's political. That's why SML's importance goes far beyond a single production site. It's an economic pillar, an infrastructure catalyst, a revenue generator, and a political symbol. Letting it decline would weaken all of these at once. Which only sharpens the question, if it's so critical, how did it reach what the government called an alarming state? When a government steps in to take over a major industrial asset, it's rarely the first option. By the time the nationalization order for SML was signed, Niger's leadership had concluded the project was on the brink of collapse. The reasons stemmed from a cascade of financial, operational, and management failures that, taken together, convinced officials there was no viable path to recovery under the current owner. The first red flag was the disappearance of promised investment. When Burkina Resources took over in 2019, it pledged $10 million for new processing equipment, capacity expansion, and efficiency improvements. But according to the government, those upgrades never happened. Instead, key machinery aged without replacement, forcing operations to run on equipment nearing the end of its life. In mining, where precision and reliability directly impact output, such neglect isn't cost-cutting, it's a blueprint for decline. Meanwhile, financial pressures mounted. Taxes were allegedly paid late, straining relations with the finance ministry and eroding confidence in Burkina's fiscal stability. Wages were delayed, undermining worker trust. In mining towns where paychecks circulate through the entire local economy, delays ripple outward as small businesses falter, suppliers go unpaid, and social tensions rise. Operational instability followed. Production stoppages grew more frequent, sometimes due to equipment breakdowns, sometimes over unpaid wages. Each pause meant lost revenue, missed delivery deadlines, and worsening relations with clients and contractors. For a country with only one industrial gold mine, even short disruptions had economic consequences far beyond the site itself. Labor policy became another flashpoint. The government accused Burkina of laying off workers without a clear restructuring plan, reducing operational capacity and pushing up local unemployment. In skilled trades like mining, losing trained workers is hard to reverse. It takes months of costly training to replace them. The crisis deepened as debt piled up. With cash flow disrupted and investment stalled, McKinnell allegedly resorted to borrowing just to keep basic operations running. Over time, the debt grew, one described by officials as significant, further reducing the company's flexibility to address operational challenges. This raised doubts over whether McKinnell could ever commit the resources needed to stabilize and grow the mine. While any single issue might have been survivable, together they formed a pattern that alarmed the Nigerian state. A nationally strategic mine was being run on a financially fragile and operationally unsound foundation. Inside government circles, the conclusion took shape: if the situation persisted, Niger risked not just reduced output but the eventual loss of the mine as a functioning industrial asset. Waiting for contract renegotiations or relying on arbitration would take months, even years, a time the state believed it couldn't afford. The decision to act was not framed as a business dispute, but as a measure to prevent irreversible harm to a national resource. Risky as it was, Niger's leaders saw allowing McKinnell to continue in decline as an even greater danger. Yet SML's story is not unique. In recent years, similar disputes between foreign mining operators and host governments have flared across the Sahel. This raises the question: is Niger's situation an isolated case or part of a broader shift in how the region manages its resources? In truth, the takeover of SML is part of a wider trend, with Sahelian governments rewriting the rules of resource ownership quickly and decisively, to the surprise of many long-term investors. In the past 3 years, Niger, Mali, and Burkina Faso have all moved away from the old model where foreign companies dominated and took most of the profits. Mali amended its mining code to give the state a larger stake in gold projects. Burkina Faso passed laws allowing government intervention in mining deemed essential to national interests. Niger, with its takeover of Renault's uranium operations in June 2025 and now SML, has shown it can turn those principles into action. The driving force is a blend of political will and economic need. Decades of foreign-led extraction delivered impressive export figures, but limited domestic benefits. Infrastructure near the mines often served extraction only, not national development plans. Many local communities saw little lasting investment, while state budgets relied on taxes and royalties tied to volatile commodity prices. By taking a more active role, Sahel governments aim to reverse that trend to boosting revenue and steering resource development on their own terms. For leaders like Tani, control is a sovereignty issue. Strategic minerals must serve the people before they serve foreign shareholders. Changing geopolitics has made this more feasible. With Western military and economic presence receding, and new players like Russia, China, and Turkey entering the scene, Sahel states now have more investment options. This competition increases their bargaining power, allowing them to push for terms that better serve national priorities. Still, the risks are real. Running a large-scale industrial mine requires technical expertise, capital, and access to global markets. Without these, production could stagnate, undermining the very benefits nationalization was meant to secure. That's why observers are watching closely to see if governments can match political boldness with operational success. For Niger, the next steps will decide whether SML's nationalization becomes a success story or a cautionary tale. The immediate priority is stability, keeping operations smooth, paying wages on time, and honoring contracts to show markets that nationalization doesn't mean disruption. Then comes ensuring the technical capacity for large-scale mining, possibly by hiring outside contractors or partnering with companies willing to work under sovereignty first. Technology transfer terms. Financing is another challenge. Without McKinnell's foreign capital, the state must find new funding as sovereign-backed loans, joint ventures with allied state-owned companies, or regional development bank support, all structured to avoid the dependency they aim to escape. Beyond immediate operations, the real question is value addition. Most of Niger's gold is still exported raw, with refining and most profits occurring abroad. Developing domestic refining capacity would keep more of the value chain at home, creating jobs and boosting revenues. This would also reduce reliance on foreign buyers who often dictate terms by controlling processing facilities. Achieving this will require a major investment in infrastructure and a strong regulatory framework, integrating SML into a broader national mining strategy, using it as a training ground for engineers, technicians, and managers that could build a skilled workforce for future projects. That would make the mine not just a source of revenue, but a hub of industrial knowledge applied across sectors. Finally, Niger must manage international perception. While the public may see the takeover as a sovereignty win, some investors will view it as a warning. Balancing control with the reputation as a reliable investment destination will be difficult but essential. One approach is to clearly spell out a new mining policy, setting conditions for foreign companies to operate in ways that prioritize national benefit while offering operational clarity. In the end, SML's nationalization will be judged less by the act of seizing control and more by what happens afterward. If Niger can keep the mine stable, expand output, and retain more value within its borders, it could set a precedent for resource nationalism that other African nations follow. If not, it will fuel criticism that state takeovers breed inefficiency and lost revenue. All eyes are now on Niamey. The political gamble has been made. The next chapter will decide whether Niger can turn that gamble into lasting economic strength.